can see about 180. Yeah, it's very quickly, rapidly, the numbers are increasing now.
It's jumping up, isn't it?
It is.
They're obviously very interested in hearing from you.
Not me, I think, everyone. Don't deflect the pressure.
Well, come on, I wasn't even on the bill until recently, so they're not interested in me. It's got to be you guys. I should probably go on mute too now.
Mm-hmm.
Okay. Hi, everyone. My name is Prasad from AICB. It's my pleasure to welcome you today to the third collaboration between AICB, FinSIA, and the Chartered Banker Institute, where we will be focusing on financial fraud globally amid COVID-19. Today's webinar, titled Fighting Financial Fraud in a Pandemic, A Global Perspective, highlights a never-ending concern for banks and other financial institutions. With trillions of dollars and large amounts of personal information stolen every year, the industry is reminded time and again on the importance of remaining vigilant and having robust fraud prevention systems in place to manage the ever-growing risk of financial fraud. We are seeing an upswing in the number of financial fraud cases amid the ongoing COVID-19 pandemic, with more vulnerable individuals falling prey to financial scams, losing their money and having their personal data stolen and misused. Globally, the banking and financial services industry is deploying a variety of defensive measures, from implementing enhanced control measures to applying emerging technologies in an effort to counter financial fraud. But the questions remain on effectiveness of the global framework. Our panel of speakers for today will share their perspectives on what banks are doing differently to manage these growing threats more effectively, and how banks, countries, and communities can work together to fight financial fraud in these times. So it gives me great pleasure to welcome our speakers for today. Rajesh Singh, Partner, Forensic Financial Crime Compliance Leader at Southeast Asia for Deloitte Financial Advisory Services in Singapore. Gavin Littlejohn, Chairman, Financial Data and Technology Association in the UK. And Richard Story, Sales Director, Risk Solutions in Sydney for Refinitiv. Rajesh has over 20 years of experience in the field of financial services regulations, compliance, anti-bribery and corruption, conduct of business, and financial crime compliance, FCC. She currently leads Deloitte's Southeast Asia FCC practice. Her clientele includes major global and local banks in Singapore. Gavin serves as chairman of the Financial Data and Technology Association, the Global Open Banking Trade Association, where he successfully led the campaign to have account aggregation added to the Payment Services Directive 2 in 2013. Through FData, he is a leader of the open banking movement and campaigns for common technical standards and a consistent liability model across the globe. Richard is based in Sydney and leads Refinitiv's Risk Solutions team in the Pacific region. He joined the firm in November 2014 and is responsible for all buy-side, sell-side, and corporate client engagements for risk data, managed services, and workflow solution offerings. His experience includes the development and implementation of KYC, AML and CTF processes and policies, as well as responsibility for managing his firm's responses to banks and other counterparties' requests for KYC data. So overall, the way we're going to run this is that each of our speakers will provide about a 10-minute introductory remarks, and then we'll have a bit of a discussion. We will have some time for audience Q&A, so please use the Q&A function for that so we can manage appropriately. And I'll try and pick these up as we go along. As is the norm now with all these platforms, we're all in different locations globally, so we apologize if the Q&A is not as seamless as it might otherwise be. We do have a business continuity plan as such. If one of us does drop out, be patient. We will do our best to keep things going and reconnect. So without further ado, can I firstly invite Radish to provide us with some opening commentary to set the scene and tell us what types of financial crime we are currently seeing and the challenges for financial institutions. Take it away, Radish.
Thank you, Prasad, and good afternoon all, depending on which part of the world you are at, and thank you for joining us. I'm going to try and just present my slides. Just please bear with me. And here you go. I think you should be seeing the presentation already. I don't really want to go through each one of them, but as Prasad said, we'll really just talk about, what are some of the key themes that we are seeing. And a lot of this that I'm going to share with you today really comes from the work that we've been doing with, with a lot of the institutions, financial institutions that we work with within the region. So in about 10 minutes, I'll just sort of cover, some of the trends, some of the issues that we are seeing, currently, as we have been speaking and helping our clients through the pandemic and the issues that are brought about by the pandemic. Right, so I think at a policy level, really, if you look at, even from regulatory or the regulators themselves from their perspective, FATF conducted a study recently, and I think even there, you see that there are delays in cooperation, and also there is a lot more leniency that is being demonstrated by regulators in order to help financial institutions through the pandemic impact as we speak today, right? And arising from that, a lot of our clients today are themselves plagued with backlogs when it comes to transactions monitoring or KYC for that matter, or even periodic review. And these are all due to broken processes, for example, right? That's one issue when, the pandemic hit. It is, as you would all know, a unforeseen risk, right, that no one was prepared for. And as soon as we all had to work from home with the lockdowns that were happening, some of our clients actually struggled to ensure that there was sufficient bandwidth and infrastructure available for remote connectivity. Now, some of us are used to doing that. We've been working that way. However, having said that, for some organizations, there was a bit of a struggle there. So I think that obviously inefficiencies in the processes were one thing that that impacted them, and then also weaknesses in controls, right? And the team capacity as well that typically supports the organization in their compliance functions, even with the capacity being somewhat reduced due to connectivity issues that also caused some time lag in their ability to continue with those processes. Now, having said that, a lot of the institutions that we've been working with have been, continuing to look at continuous enhancement, right? One is obviously reacting to the current pandemic, but then some of the organizations that we've been working with had already gone down the innovation journey. So they tell us that they faced lesser issues.
Radish, could I just ask if you could put it in presentation mode so the screen's bigger, basically? I think all
right. Is it now in presentation mode? Oh,
yes,
okay. My apologies. Yeah, because something went wrong here. I apologize. Technology perhaps is not my my forte. So coming back to the presentation, if there are any issues, just let me know. Essentially, coming back to the discussion as to how the financial institutions are trying to fix the issue. Now, as you know, a lot of you would have read the FATF report in terms of the increased criminal behavior, as well as the change in customer behavior that financial institutions are already dealing with, right? Because your typical transactions monitoring systems may already looking at a surge in alert volume simply because of change behavior, and not all this behavior is related to financial crime, but it is new for the monitoring engines, and hence they do, they were becoming at some point, and even today, as we speak to our clients, they continue to become an issue that they need to address, right? So you really need the ability to create the dichotomy very quickly of issues that the bank need to focus on, which is related to financial crime, and those that are not related to financial crime simply because the consumer behavior or the bank's customer behavior has changed today in the way we operate, in the way we actually do online shopping, etc. Right, all sorts of things. Having said that, though, criminals have been taking advantage of the situation. There's been a lot of misuse, of online financial services, virtual assets. There's been reportedly surge in phishing, check fraud, fake charities, fake COVID cure claims that seek to raise funds, etc. And all of these activities are going through financial institutions, right? And one of the other things that we have cautioned a lot of financial institutions, we have done the reviews, is that where businesses that typically should be impacted or negatively impacted by the COVID situation, if they continue to show some healthy transaction volume, then that in itself is a problem, something that banks may want to start to look at. And obviously the typologies are certainly changing very, very quickly, right? So what are institutions doing today to deal with this issue is really that they're taking a step back and not necessarily throwing bodies at the problem, because that sometimes doesn't solve the problem. Yeah. So they're looking at a long-term, a medium to long-term solution and how best to handle a situation and enhancing their due process around any unforeseen risk that they may be impacted by, right? So whilst they try to deal with the, the volumes, etc., and deal with the ensuring that they have robust capability to monitor financial crime, at the same time, a lot of the organizations that we're working with are taking a more sort of a holistic approach to ensure that from governance angle, they make the right decisions, they have capability to enhance systems and ensure that it's all scalable over time in order to address any kind of unforeseen risk, right? So and of course, like I shared earlier, there are operational challenges. There are obviously new typologies, new type of crimes that are emerging. But what we're seeing again is that at least at this stage, few months into the COVID situation, we're seeing lesser knee-jerk reactions to this, right? So a lot of institutions are now taking a handle of the best way to deal with it in a long-term fashion, right? And what we're seeing, and what have some of the key considerations been of financial institutions, I've just summarized that on this slide. One is obviously looking at capability enhancement, right? And I think increasingly today, a lot of our clients are looking at ensuring that they design and build capabilities that provide them the ability to detect and prevent financial crime, and in any unforeseen circumstances, if that there is a risk that you have to address, then you have the ability to react to that far quicker than you would otherwise, right? They also continue to look at cost and efficiency, effectiveness, removing redundancies. And one of the things that we are seeing increasingly happening now, and we're working with a number of financial institutions, is to look at dynamic customer risk management, right? Dynamic meaning that we use all data sources to look at risk in a more dynamic fashion rather than waiting for transaction alerts or otherwise looking at periodic reviews. So that is changing drastically. We don't necessarily have a ready solution today, but a number of financial institutions are heading into that direction, right? And also obviously looking at where we can remove redundancies, use innovative approach in order to ensure that the process of complying with financial crime compliance and the ability to address risks that emerge in unforeseen risk situation become a lot sharper. And like I said earlier, the banks that have been on the journey of innovation actually shared with us that they face lesser disruption in order to continue to comply and monitor financial crime in the current, pandemic situation. Though the issues were there, but it's just that they had a greater ability, a greater sharpened ability to deal with that. But and learning from there, we do see a number of financial institutions today going towards digital transformation, optimizing and leveraging on technology, use of AI, machine learning, RPA, in order to sharpen their processes and capability to mitigate financial crime compliance risk. And that again comes with operational excellence, transformation, creating more efficiencies, ensuring that the FCC output that you're getting from your systems and your people is a lot more reliable, right? I'm going to just skip this. I think we need to, kind of move on, and I'll also pass on back to Prasad to, have Richard get on with what he needs to present. But I think the other thing that, like I said, we're seeing is really the whole digitization and reimagining of the whole KYC process. It's not just about KYC, it's really about building and enhancing capability to monitor and manage financial crime compliance or financial crime in a better way, sharpen your compliance capability. A number of financial institutions are already on this journey, digitizing the process, looking at dynamic, customer risk monitoring. Ultimately, the goal is that if we can demonstrate to the regulators that customer risk can be monitored in a dynamic fashion, and the bank has greater ability to understand customer behavior, right? React to it faster, because you will have sharpened detective and preventative measures in place. I think ultimately the idea is also to move away from a lot of redundant processes and human-intensive processes like periodic reviews, et cetera, right? So we're really looking at a paradigm, shift over time, right? So that's certainly, I think what's happened is that with the pandemic, it's given financial institutions a lot of business arguments to embark on the innovation journey, right? So that's certainly something that we're seeing. And the other thing I'd like to just very quickly share with you is that, a number of jurisdictions, and we are working with a number of jurisdictions here on industry level utilities, not just for KYC, but also for transactions monitoring. And watch that space. It's something that's coming, and I think a lot of governments and regulators are interested in that, perspective, in ensuring that monitoring happens at industry, on national level, right? So that's something that we are certainly seeing. And I'm just going to close off by saying that, where are we going when it comes to sharpening our capability in managing financial crime in a better way, right? Ultimately, this is something that is a bit futuristic, but we are working with a number of our clients to think about holistic surveillance is what we call it. And some banks have already started to look into this, and they're piloting and looking at means and ways of doing this. But I think what we are advocating is that we need a different way. If we want better results, we need a different way to do things. And ultimately, it is holistic surveillance that we advocate. This is in itself a long discussion, but generally the idea is that to augment the capability with various data sources, with enhanced typologies, internal and external threats to be considered, change of customer behavior. There's already a whole lot of science behind that we can deploy today, and really look at what is material that the financial institution will need to focus on when it comes to financial crime compliance, right? So if I can simplify that, that's really what it is, right? That's where we're heading to. It's not there yet today, but I'm positive that in the next few years we will get there, right? So with that, Prasad, over to you.
Thank you, Radish. Thank you very much. Can I now invite Gavin Littlejohn, Chairman of F-Data Global, for his opening remarks, please?
Thank you very much. Yes, I wanted to just give an overview of some of the attack vectors that have been introduced through the current situation, and many of the end outputs of these attacks are running back through the same rails. But of course, as governments throughout the world have rather spontaneously decided to try to inject cash into the economy through the financial sector to prop up typically the small and medium businesses and other sectors, the normal processes through which those credit applications or grants have been governed from a KYC and fraud prevention perspective have been slackened and often in a wholesale manner. And the result of that has been very large-scale fraudulent applications, and then coupled to money laundering, where the money moves round the world very quickly. We've also seen instances where people's identity has been hijacked. For example, there have been information provided of people's shops that haven't been rented out, have been used to prepare applications for credit, which are obviously not from a real business occupant of these shops, and where but because they're lying empty, they've been used for that purpose of preparing fictitious accounts and information to gain access to it. More broadly, we see the long-standing problem of money mules and fraud taking place in an international context. And I was interested to hear Rishi's thoughts on national sort of industry coordination. I think, maybe even going beyond that, we really need some international framework for this observation, which is something that I'm heavily involved in coordinating at the moment. The ability to look at pattern recognition at scale is critical, and of course we don't have a track record really of for example, one retail bank sharing at scale their customer data with another retail bank, or in reverse, to help with that pattern recognition and fraud prevention measures. My industry specialism is in the field of open banking, so we've been trying to do, as data gets shared by the end customer between financial actors, trying to do some ecosystem coordination in that particular regard. One of the things that we've been very keen to establish in markets where open banking or open finance is taking root is to develop a trust framework between the regulated actors. So typically this takes the form of, on the one hand, a regulatory application by the participants, so that the regulator has authorized them and of course identified them. And then secondly, a coordinated industry directory that is cognizant of who those regulated actors are, to the extent that when any data is shared via API, that there's an ability to check the register of regulated actors and ensure that the ecosystem is completely closed, and that prevents, to a certain extent, some of the phishing and spoofing attack types, because you couldn't reasonably pretend to be an actor to get the customer to hand over data. The data can only be exchanged between the regulated entities. But that still leaves a very significant gap. If this were telecoms, we would often refer to the last mile out from the exchange to the customer. And indeed, we still have a problem in financial services in the development of digital identity. Some countries have had a go at it and are doing very well. And those identity types typically take two forms. One is where we have some national scheme which is orchestrated and may connect with biometric identity. and the other is a claims-based system, which is inherently weaker, but it's also, for many markets, for political reasons and cultural reasons, more realistic to expect. So a really strong ecosystem that would help to prevent and eliminate fraud would be where data can only flow, payments and financial data can only flow between regulated actors, and between those regulated actors and their clearly identified end customer. And where there was some coordination of that identity sharing. I've been following with great interest the work of the OpenID Foundation, which is now looking at eKYC. And I think that's a very natural market addition to what has already been created in the financial grade API, the so-called FAPI standard, which is built on OAuth 2 over OpenID Connect, which is how data is becoming increasingly shared in multiple markets. It's been adopted in the UK, adopted in Australia. It's in the process of being adopted in the US with the Financial Data Exchange. And I know a number of other major international markets are looking at it. So if you're able to get the common technical standards for the security profile for how data is shared, that greatly tightens up one source of attack vector. And then if you were to combine that with the claims-based eKYC to digitally identify the end customer in a robust manner, which does require some government policy to enable it, but the technical standards are clearly emerging. We could have a very robust international framework for how we effectively ensure that the data is only flowing between the parties who are supposed to have it, which I think is obviously a significant strengthening against the risks of fraud and money laundering. The other thing that's interesting in this domain is what happens when things go wrong. And in a traditional market where there's a linear relationship between the customer and their financial provider, and they know if they're insured by somebody or if they bank with somebody, and the problem is a financial product, they know where to complain. They complain to the provider of the product. If a payment goes awry, then they have a normal recourse through the institution or through the scheme for some compensation if the payment going awry was not their fault. And in the sharing of financial data as we move across the globe to open banking and open finance, the data sharing is by several degrees more complicated because it's no longer a straight line relationship, because the same customer could share data from one regulated financial institution to multiple regulated actors who are the legitimate actor, but they may not know if things go wrong, or if somebody gets hacked, or there's an identity theft issue, which of the actors has been responsible, because the data could be shared to 5, 10, 15 different companies perhaps. So there really needs to be a better methodology baked into the design for traceability, coupled to a much enhanced understanding of the cyber risk and cyber insurance framework that would make the customer whole and provide some compensation and method of customer redress. And I don't feel any market in the world has got that particular problem in hand to a sufficient degree. I think the evolution in this domain has focused on the law and the technology and the regulatory framework, but hasn't really puzzled out the complexities of this plural market, and how redress would properly take place when it's data and not value that is the issue at hand. So I think that is an area where I think we're going to have to see material, thinking and kind of system redesign to try and enhance the customer protections, and at the same time as working on the reduction on the patterns of fraud. In terms of particular attack vectors relating specifically to open banking, I guess the pathways are maybe slightly different, but the method of attack is similar. What I mean by that is it's still social engineering, but rather than going through the path that is direct to the bank to try to get people to hand over information about them, which would enable theft to occur, typically theft or other forms of fraud, they're going through the regulated third party and conducting the same method of attack. One of the things that's very strong in addressing that is being able to create this consistency of software signing within the framework, and making sure where there's what's often called a data aggregator in the middle between the customer facing third party and the data donor institution, typically a bank, that all of those parties are party to the liability framework and to the security model, and that the regulators have designed all of the roles that are really in the market into the model. In many instances, we've seen that particular issue missed. So they were kind of my opening remarks, but of course, happy to take questions when these come around.
Thank you, Gavin, very much for your remarks. Can I now invite Richard from Refinitiv for his remarks now?
Thanks very much. Yeah, look, I guess from our perspective, I work with large banks and with regulators around the region, and the pandemic really has driven, in the areas that we deal closely with, a massive adoption of technology, pretty much in all areas, even from the very basics. So a lot of the banks in Australia and in the APAC region that we dealt with weren't prepared for remote working to the degree where many of the relationship managers in some of these large banks didn't have laptops. They worked basically very old school combined with desktop computers back in the office. So the pandemic itself drove this virtual office environment, which meant really rapid adoption of very basic technology. And obviously that opened up security risks for the banks, or had the potential to do so. So really what we're sort of seeing as a result of the pandemic is much, and I think as Radish spoke about earlier, a much quicker adoption of technology, and so a shortening of the processes that large institutions like banks and the bigger fund managers and pension funds, a shortening of the processes that they step through in order to approve the use of new technologies. So a lot of the topics that Gavin was talking about and that Radish had talked about have been under discussion for many, many years. Singapore was going to adopt a KYC utility back in 2015 and 16. I worked on that extensively with the MAS and with the large banks in Singapore. It was a great project and we really thought that was going to go all the way. However, it didn't. But a lot of other projects have been picked up and, not rushed through, but moved through a very much a condensed approval process, perhaps to some extent because a lot of these projects around technology, such as, virtual environments, but also around eKYC and utilizing AI and machine learning to gather data on potential customers. A lot of these projects have been under consideration for 6-7 years now. And so with the impetus of the pandemic, what we saw was, I think, a lot of decision makers within larger banks getting a bit more of a free rein to move on with some of these considerations that they'd had sitting, bubbling away for some time now. And I think, whilst we saw the simple sort of technology around the use of, Microsoft Teams, and now, we've seen that move into a more more sophisticated technology, the use of the blockchain. We talked about this, many, many years ago, and the blockchain was going to be the cure-all for all. However, it didn't pan out that way. But then we're now seeing that there are, products such as the identity overlay product that some of you may have heard of, that's being used by a very large Asian-based bank as a way of sharing identity documentation and doing that efficiently and quickly. It's now being adopted by or it looks as though it's going to be adopted by a credit card vendor as well. So, we're seeing these new technologies being adopted more quickly than before. And I think it appears so far, and it'll be interesting to hear from Radish and Gavin as well on this, but it appears so far that the adoption of more of these technologies hasn't led to an increase in fraud as such. Obviously, there's been an increase in different types of fraud attempts, and there's been increase in different types of financial crimes. But I don't think it's the technologies themselves. So it'd be interesting to have that sort of conversation around whether or not the technology that's been adopted more quickly has leaked. I don't think it has. At least that's not what we're seeing from our clients and from our regulators. What we are seeing too is that the banks, in particular large banks, are increasing the sophistication of their transaction monitoring software. So they're moving, again, more quickly because of the pandemic. They're moving to more sophisticated software that can do more than just look for transactions that breach a threshold or look for nested transactions for financial crime sources. They're looking now more at, being able to combine different patterns and link those different patterns in a much more sophisticated way due to more sophisticated software being accepted and adopted sooner than it has been in the past. Down here in Australia, we're seeing, startup software companies also being given a chance to operate. So companies that started in 2014, 2015, that have been working on POCs with the big banks and sort of talking to regulators to make sure that their sort of products are going to be accepted by regulators. We're seeing those products actually come into POCs that are live with large banks. And so the sort of things I'm talking about there are software platforms that, again, enable that, as near to real time KYC and AML screening at onboarding. So instead of having to onboard a client, whether it be a large entity or whether it be an individual, as quickly as possible, and then day 2 and day 3 run through AML screening and then perhaps offboard the same client because of issues that are found in that screening process. Now we're seeing that AML screening move right up to basically being pretty close to real time at the point of onboarding, and that's because of the adoption of EIDV, so electronic identity, so digital identity verification, and that's been encouraged by the regulators down here in APAC in particular. I mean, obviously Singapore with the MAS, that's a classic example where they've done more than just encourage it, they've actively enabled it. Whereas, in Australia, we've sort of done more of the encouraging rather than enabling. But I think it's the pandemic itself has really helped to give impetus to open up the thinking of governments, regulators, and then also of the larger financial institutions, which in many cases do act and move a little bit more like a government institution than an actual corporation. So that more sophisticated software, so linking patterns and relationships that enable better analysis and quicker analysis of data, and that's really been very important, particularly in the pandemic where they've lost the ability to actually eyeball individuals. So, obviously in the past with banking, a great deal of the AML process was actually really successful because of personal relationships. Being able to see someone when they came into a bank branch gave you a feel of whether or not they were a suspicious character, which helped with the identification of suspicious transactions. That having gone, we've now got to rely more on digital identity, on the verification of identity in a more rigorous way than perhaps in the past. And we've also got to rely on the software to link these relationships as well as transactions in order to drive an analysis that can give an outcome that identifies a transaction as suspicious that we may have picked up in the past through person-to-person contact. So I think they're sort of some of the key changes that we're seeing in our client base and in the regulators that we deal with. I think all of the regulators are, really trying to encourage the adoption of these, digitalized processes and the automation of processes so as to shift the focus from, you know, a great mass of analysis of what is very much typically low risk, and focus scarce resources on the higher risk individuals, entities, and transactions. And the use of you know, these software platforms that I mentioned before that help to gather the data, they can now process the data, run it straight through some AML screening, and very quickly use a traffic light approach to either completely stop dealing with someone who, or an entity who is on a sanctions list that needs to be adhered to, perhaps give an orange light and refer back to a financial crime team for someone who may be, you know, a PEP, so a, you know, politically exposed person who needs to undergo some more due diligence, but give a green light to the vast majority of individuals for whom we can now electronically verify the identity. We can very quickly screen, find that they're not actually on any of the AML lists that we need to be aware of, or, you know, look at a you know, a listed company on a recognised registry, and move those very quickly straight through the process and have them onboarded. I think the other thing that we're seeing is more of an adoption of the ongoing client due diligence piece than we did in 5 or 6 years ago. Moving from the periodic, which Radish again mentioned, periodic KYC processes where we laboriously and manually regather KYC data from, you know, corporate registries and from clients themselves, and then go through a full KYC process again and try and do that every maybe 1 year for high risk customers. Generally, most of the institutions we deal with would fail to get through that project volume. So now what we're seeing is that the platforms that they're adopting, you know, like things like Simple KYC, which is not our product, by the way, but nonetheless, using those platforms, they can have an iterative, ongoing observation of the client, and so continued knowledge of the client themselves and understanding of who the beneficial owners are, who the controllers are, continually screen those. Again, using software, they're able to hit data, AML data, to see if there's been a change in an individual's listing on a sanctions list, or perhaps even a change in their role as a PEP. Those sorts of automations we're seeing now with, you know, to a large degree, it is with the, you know, the startup banks as well. It's easier for them to basically have no legacy platform. They can start from scratch. They can do everything digitally. We all know that's a lot easier path, but what we are seeing is the bigger institutions then having, you know, I guess, incubating their own little digital banks. That's happening a lot more, certainly down here in APAC. That's what we're seeing a lot of anyway. And they're using, instead of using really big, heavy, bespoke sort of platforms, they're tending to use off-the-shelf platforms. So like Microsoft Dynamics or Salesforce, using those sorts of software platforms, often looking to use them as a, you know, in a SaaS version rather than deployed, and, you know, taking off-the-shelf product, slight modifications, but beefing up the security, and using those sort of platforms not just as a CRM anymore, but using it as a way of running through that initial onboarding and then running through the ongoing client due diligence process in the background as well, and the screening process. So I think they're very real areas where we're seeing a difference. And they're probably, I guess, the key pieces that I wanted to talk about, or at least, you know, share the observations that we're seeing with our customers, is that move to digitization and automation. We're seeing it mostly with the smaller organizations or with the larger organizations, incubated business units underneath them. And, you know, we are seeing it be really quite successful. You know, there's enough, you know, due diligence around those players themselves that we think, and what we seem to be seeing, is that there's enough security to encourage continued adoption of this digitization and automation. So I think they're probably the main sort of points I wanted to raise. So perhaps now we could go to more of an open discussion.
Thanks, Richard, Gavin, and Radish, for the insights and perspectives. So let me start with a few Q&As myself first. I just wanted to, if everyone could turn on their screens and unmute, I'd be grateful. Thank you, guys. I just wanted to start with a broad question of what do you see as the key themes for fighting financial crime in 2020 and beyond? And what are the best practices you have seen so far through any one of you? Perhaps starting off with Radish?
Thanks, Prasad. I kind of knew that was coming my way for Well, I think in terms of, what are the trends, I think all of us talked about issues. I think today's key concern is digital, identity, as Gavin, spoke about. Richard talked about the same thing, like I was mentioning, transformation, digitization, a use of AI, machine learning in combating financial crime. Now, and I'm in agreement, with Richard as well, that this is not something that's happening because of the COVID. But what COVID has done is that it's given it a little bit more impetus, right? To and financial institutions to say, yes, actually, if we innovate and we create efficient processes, then we're a lot better at managing unforeseen risks, right? Or when we're hit by unforeseen risks, right? So that, I think, is really what we're seeing happening more than just simply looking at trends, as it were, right? And if you look at what some of the operational challenges are, is and Gavin spoke about that as well. We actually had clients tell us that they were still operating using a desktop, for example. And when the pandemic hit, they very quickly had to adopt to the new normal and create, the sort of capabilities for connectivity, right? So I think broken processes, redundancies in the way, or lack of efficiency in processes has been a key issue. And what that has done is that, created obviously a lot of operational challenges, right? In terms of volumes, more volumes of alert, creating connectivity, making sure that people have the capability of understanding new typologies, new kind of, activities, criminal activities that are emerging through, transactions and the change in customer behavior, right? So those are certainly the issues, and how are people dealing with it. I think, I'd say that one is through a more integrated framework. One is which is really to respond to the current issues by ensuring that, one is that you have capacity in place, you have efficiency in place, you have good governance in place in order to ensure that you are financial institutions able to continuously give effect to their compliance obligations, right? So that is something that we certainly see as immediate term measure, but the medium to longer term measures now is to push forward the agenda on innovation, use of AI, machine learning, digitization, transformation. And transformation mean different things to different financial institutions, right? The larger global financial institutions, for them, transformation could also mean resource allocation, cutting out the fat that's in already that already been sort of gathered over time because of the enormous size of their programs, and for the more emerging economies, transformation could mean that creating greater efficiency, right, in terms of adopting new technology, adopting innovation, right? So they're all at, we as we work across the industry, we see different levels of sophistication, and there's no one size fit all, really. Yeah.
Any comments, Richard or Gavin? Sorry.
If we've been working on the throughout this conversation about the external security and identity, I'm slightly curious with the hundreds of thousands of workers who work in financial services who've been sent home, who would normally be under the internal security supervision of their organization. Do you think there may be increases in opportunities for fraudulent collaboration between people working at home and their potential criminal friends?
Yeah, for sure. And we're seeing a lot more interest from those institutions around how to monitor all of the technology. So monitoring the mobile phone, the mobile phone messages, the chat rooms that they're in, the chat platforms that are authorized and the unauthorized ones. So being able to gather all of those different sorts of communication, including the basic emails and everything else, pull it all together and analyze it all. We're seeing that as being, a key piece of work that's been going on now. Again, it's a little bit like everything else that we were talking about before that, I was discussing before around the KYC stuff as well. Monitoring all of this activity and all of this communication has been on the agenda now for a long while. And there's been a lot of technology that's been taken up by the banks over the last 5 or 6 years to help to do that in the scenario that you talked about in the trading room itself. Now that they're all remote, it's the application of all of that technology and that capability to their individual, remote locations. And that's being enabled by the technology now. So I think, whilst it did present a huge challenge for some of the banks that I mentioned before that even didn't have, laptops for their workers. They didn't expect their people to be outside of the office whilst, really transacting. Those banks have had to move very quickly to be able to monitor all of the different communications and then cross-reference that with, trades and transactions as well to then look for those patterns.
Are the staff, do you think the staff are aware of that, and are employees comfortable with the level of surveillance they're receiving? The privacy?
Yeah, I mean, the privacy piece is always a huge, a huge emotive conversation, particularly in places like Australia and the UK, I know. And down here, it's a big deal as well. I think the pandemic has given people probably a little bit more of a cause to be a little more open around these sorts of pieces of software and this sort of monitoring. I mean, I could be wrong about that. It's just anecdotal, really. We haven't done any research around it, but what we're seeing is that the banks and the people who work in the banks are more accepting of this sort of monitoring. And we're seeing a lot more interest in any of our sort of partnerships with those sort of software providers. So I think there's still a concern. There'll always be a concern around the privacy and the invasion of someone's home effectively. But, I've known a lot of the traders who are the ones who are most observed. And, these things have been going on for a long time. So, we've had a lot of traders who have, been pulled into HR meetings, 5, 6, 7 years ago and sat down and asked, well, why did you send this text to, that person? Can you explain what that means? So
your calls are recorded anyway, so, and always have been. But the thing is, from what Gavin said, there is a cultural difference. Radish, I wanted to ask you if you see. I mean, Richard's mentioned that the UK, there is an issue with the UK and Australia as far as privacy goes. Are you finding that in Asia Pac as well?
Well, look, the data privacy laws exist in APAC as well, right? A number of countries have adopted them. The international standards around data privacy generally are the same, right? But I guess it's also the, if you look at from cultural difference perspective, right? Are you comfortable with someone undertaking surveillance on you? Again, this is my view of having spoken to people. I think people are not necessarily comfortable, but there's no choice really. And a lot of people who are, I mean, let's put it this way, that the fraudsters and the criminals are not the large numbers, right? So the people that really are being subject to this kind of surveillance today are really the good guys, right? And they get on with it because for them it's that's fine. If the organization needs to protect itself, then fair enough, right? And that's generally sort of the theme or kind of the thought process I'm seeing in Asia. And I think increasingly because of the nature of financial crime, susceptibility to fraud, and I think, Gavin and both Richard, you talked about this as well, that increasingly now with remote working, it's possible sometimes to fall prey, not just colluding, but falling prey to fraudulent activity, right? So, the need to protect the organization from financial crime and also commercial losses associated with that is becoming increasingly important, right? So, I mean, essentially, you come to the party with an open, with enough information that this is going to happen, right? And I think that's just the way forward. That's just the way it is. Now we may debate about privacy issues and the fact that people are being monitored in an unfair manner, but I think the organizations look at it more from a protection perspective, right?
And I just wanted to get an idea. There's no doubt that automation and eKYC, is being embraced, so on and so forth. But just wanted to get a sense of what you guys thought. How are the regulators coping, really? And the other thing is also, with the speed at which things are getting adopted, how are boards coping? Because I think that I just get the odd feeling that they're not quite being informed at this speed, essentially, and that's could become a huge concern going forward.
Yeah, I'd say so for sure. I mean, I think we just saw today one of the big four banks chairman, announced that he's leaving. So it was David Gonski leaving the ANZ. So they're not under any pressure, other than obviously, he felt like his time is done. At least that's what's been released to the press. And he was, ANZ's done incredibly well around this AML piece. I've got to say, I would call them out as being a leading bank around AML. Hopefully, not that we know announcements that will prove me wrong, but under David Gonski's leadership. So I think the boards, really have struggled, and you've seen that particularly in Australia, where we've had a lot of board turnover. It's been very difficult for them to understand really what their organisations should be doing and are currently doing around management of risk. Outside of the basic financial risk, I think they've gotten their arms around the financial risk piece to a greater degree, the operational risk. And so risks such as AML really have challenged them hugely in the recent past. They struggle with that. And I think to a large degree, a lot of that's because of a slow adoption of technology, and a slow, I guess, because really in the past, they really have struggled to find a way to truly manage, the potential for money laundering, because it's always been very manual. They haven't adopted enough technology to be able to deal with really the tiny percent of people who are criminals, because they're spending all of their time looking at the people who are really low risk. So, I think it's now that the technology is coming on board that it is enabling a greater, a greater thoroughness around preventing financial crime. And that really what's driven that as well is that the regulators are embracing it more. And so they're encouraging the chairman of the banks to do this. And certainly, from the whole, chairman and the board all the way down. So, when we look at the regulators in our region, you go from one regulator who's, who we all know of, who's, actually facilitating digital identity. And so they're gathering the data. They've spent years linking the government departments' data sources together, and then enabling via the use of API, so enabling technology for, third parties such as the banks, authorized third parties, to dip into that data and use it to verify the identities and use it to verify, other details around individuals and entities. So from that sort of a regulator, you've then got the slower regulators, who don't have the luxury of that particular government setup, who are doing their best to change their regulations, or to at least change their guidelines on how to implement the regulations. And so to open those guidelines up and encourage the financial institutions, who are the de facto sheriffs of money laundering and financial crime, encourage those sheriffs, if you like, to use the technology more. So the regulators are trying to move as quickly as a regulator can. That's at least my view, and that's what we're seeing.
For me, there are two fundamental challenges in becoming really, really good at combating money laundering. I'm not going to talk about being good at anti-money laundering, because it seems like we focus on collecting data points. So firstly, the primary identity is weak across most countries, because it's based on claims for places which have not been substantiated. So we typically start off on some register of births, marriages and deaths when we're born, and we're issued with some, your parents are issued with some certificate to say who you are. And then that may be used in an application for a driving license or a passport or our first bank account. And from there, it just builds, everything else then gets built on top of those other things. So if the tie and the bind is not sufficiently strong to start with, then it can be perpetuated. That's one weakness. The second is, we have to assume, and always assume, that the criminals are really, really capable. And I'm not really sure any criminal tries to now, by definition, to launder money, it has to be moved. And I don't see any criminals trying to launder money within one bank, within one country. I mean, it's just crazy. Nobody would do it. You would get caught, because the internal bank systems to monitor those patterns are sufficient, or, they're getting quite good with the sort of machine learning capability that's being deployed. So what we really need to do is beef up improve the quality of the primary binding identity, and increase the international cooperation to track patterns as the money gets switched very quickly around the world. And if we don't do both of those things in tandem, the money launderers and criminally intended will always have a material market advantage.
Well, I just wanted to come back to the whole, onboarding a clients kind of thing, so on and so forth. Look, China's very open to using facial recognition to open accounts at China Construction, and you get all these wonderful stories about China, but if someone like me is not willing to get off his iPhone 8 Plus because I don't want them knowing, et cetera, how is this going to, help? I mean, it could end up being the solution, but something that no one's going to accept. Does that make any sense?
Yeah, well, I mean, so in one of I'm not sure if my facts here. So this is a hypothesis. So most of the biometric identity systems that are connected to a mobile device enhance security when the biometrics are being used, but they always have a weakness that goes alongside them, which is that that there's always a second pathway. For example, a 4 or 6 digit PIN. And
right.
I'm not entirely sure if you wanted to crack a security profile using that technique, you wouldn't attack the area that was hard to crack. You would attack the soft underbelly, which is this simple PIN. So I think the combination of a stronger bind between the true identity and the artifacts that are the claims, and trying to move away from leaving those fundamental user case weaknesses in the system, which may mean that people, for example, can't get into their mobile phone. Those sorts of issues may be still issues to resolve, I think.
If I could add to that,
yeah,
please. I think, sorry to interject there, but I think that what we need to embrace is that the world is getting more and more digital today, right? And digital onboarding, digital identity authentication is really going to be the way forward. With digital banks coming on board, you've got the payment companies that today really are technology companies, right? They're not necessarily your brick and mortar type of businesses. What is important, and I agree with Gavin, is the fact that the security protocols around that has to be robust, right? And I think that's increasingly, what we're seeing today. And of course, there are two types of organizations still, right? Where we ourselves have been speaking to boards that have that really embrace the whole innovation, digitization rather rapidly, because one is that the regulators, to Richard's point, are pushing the agenda, or also they have seen the value of it. It's been a journey. It wasn't there 5 years ago potentially, right? But it is there today because they've seen the enormous efficiency gains and operational excellence. And the ability to focus on what is material rather than looking for a needle in the haystack, right? So that sort of paradigm shift is happening. It's not necessarily uniform across all organizations, but we're seeing, that it is there, right? But yeah, I guess we can't run away from the fact that digital identity is going to be here to stay, and we can't fight it.
Things, can I hypothesize? Tell me if you think it's that. Gavin said that I think a lot of the cross-border stuff, is where things happen rather than in-country stuff. But as far as the rise of, say, fraud during COVID, could it perhaps be down to the simple fact that the most vulnerable sectors of society who weren't willing to use technology have been forced because they simply can't walk into a branch anymore, and therefore that it's perhaps that's given rise to this higher amount of fraud to that section, perhaps. and that a lot of the work from home stuff that Richard was talking about has not really applied to those who have been working on trading desks, because for the last, I mean, 20 years at least, they've been subject to a whole lot more of, you know. So one would only have to look, if you were a bulge bracket bank, wouldn't you just have to look at your investment bank to see what you have to do for your commercial bank?
Well, yes, it's just that it's on a whole new scale, isn't it? So
No.
we, it's on a whole new scale in terms of number of transactions and number of individuals, so points of contact. So that's where it really gets difficult. And then you also have, the difference between the people that run the retail section of those bulge bracket banks and the people that run the IB section. And they're very different cultures. They're very different people. Having dealt with both of them, I'm sure all the panelists would have dealt with both of them. Many of the people in the audience would fall into either or both of those categories and work through both sides. But, they're very different sorts of businesses. And so, using the same methodology and just trying to scale it has been what, most of those sort of banks have been trying to do. And they've done it with some success, but it hasn't been an easy journey for them. And they've leaned heavily on the consulting firms to try and help them find a way to do this. So I don't know, Radish, have you sort of had much experience or had heard through the firm these sorts of war stories of that transition from, the IB side to the retail side?
You're right. And my own background is global banking and markets compliance, right? So I'm more exposed to, investment banking kind of business. But in my consulting experience, I've done work for private banks and retail banks, right? And they're very different. One of the key things, and I can give you one example that's a bit easier to digest, is the fact that when we look at how to monitor financial crime, we go into segmentation. So you really will need to, undertake segmentation of your customer base and the kind of risk that they can be susceptible to, right? Customer profile, customer behavior, and obviously, doing the sort of that link analysis, right? Looking at, typically how, the kind of behavior contributes to the risk of the customer and to detect anomalies, if I may use that term. That's the only way we've seen it becoming, successful, right? You can't use a broad brush approach. That has been criticized by regulators and results in just, again, too many false positives and so on and so forth, right? So I think one is going granular, looking at, segmentation, and of course today the use of AI, and machine learning, and of course this is public knowledge. We've published 2 white papers with UOB, Singapore Bank, that's been on this journey, and we've been their partner in order to validate that journey. I think what I can safely say is that the use of AI and machine learning certainly triages your capability, right? And allows the bank to focus on what is material. That's certainly, we can confirm that that's already happening. But I think also that, the sort of ability to enhance typologies, right? And constantly look at what are emerging threats that you need to be prepared for. And that's where sort of the machine learning element of it comes into play. And that's really been, been the journey, at least of this bank, in order to make more sense of the amount of the amount of, big data that you're sitting on, and potentially looking at things from, different type of customers, right? And behaviors as well. Yes, and I do think that, yeah, the segmentation is one way to, to go, right?
Absolutely.
Gavin, can I come back to you? Just this is a very basic question, but what is the difference between specifications and standards? And in your experience, it looks, is something like GDPR the gold standard in all of this data-wise?
So GDPR has a number of fundamental flaws. I mean, GDPR has a process to go after those who have a weak capability, but does nothing for the end customer if their privacy is breached. It doesn't, and there's that's really the difference, I guess, between something like GDPR or the other data protection acts that are evolving in different markets, which are similar. They differ from the sort of things that we do in financial services, which is when we've made mistakes, we provide a mechanism for compensation. Addressing the first part of the question, though, specifications and standards, I think we've been looking at the rise of gateway APIs to move financial data across multiple markets. Most of those initiatives, those standards, so-called standard generating initiatives, have developed a specification that all of the parties must adhere to. But we've just discovered that, and you know, I have to confess, and it might seem obvious to others, and I definitely didn't know this, but there's a material delta between building software to a specification and developing a standard. We discovered, for example, in the delivery of open banking in the UK, that all of the large banks self-attested that they'd built to the standard. And then we discovered when we tried to make the connections between the parties that the specification had been interpreted slightly differently. And APIs, when they're working well, should work like an electrical plug and socket. You should be able to build once and apply many. And it wasn't until we built conformance testing software that algorithmically covered the pattern of both the electrical socket, if you like, and the plug, that we were able to really get to a point where the engineering costs went down, the security risk went down, and we were able to really bind the whole ecosystem into a really efficient standard. And that, we're going to see that in as open finance rolls out across multiple jurisdictions. At the moment, there's work underway in Japan, South Korea, Australia, India, Singapore, Taiwan, Russia, US, Canada, Brazil, across the European Union, Central and Eastern Europe. I mean, there's there's lots of initiatives emerging in Africa, in the Middle East. So really, in most markets I can think of now, they're tiptoeing into some form of open model where data can be shared between actors. And if we don't absolutely nail that conformance testing approach, the risk and the engineering overhead will be insurmountable. Literally, there's not enough engineers in the world to deal with the problem.
Right. Okay.
Whereas the alternative of delivering proper international standards for this will have a material effect on global GDP because of the friction it creates in financial services.
Right. Okay.
It's a big way.
It's a big thing. I wondered if anyone else had any final comments to make, anything that they feel they need to get off their chests now. If not, I've got to wrap it up. It'll be lovely to chat, but we do have to move on. I want to, on behalf of everyone who's come, I'd like to thank Radish, Gavin, and Richard for the great discourse and for taking the time, really, to share your knowledge and experience with our members. Thank you as well to all who attended and engaged with us. We hope you've enjoyed the discussions today. Apologies that we were unable to accommodate everyone who had questions for the speakers, given the time constraints. Thank you also to our members and members from the Chartered Banker Institute, FINSIA, for your attendance today. I hope you found it useful. Please participate in the webinar survey via the link in the chat box, which will be presented shortly. We welcome your feedback, which will go a long way towards helping us improve on the delivery of these sessions. And you can also get your CPD points. Now, an unashamed plug here, across our 3 organizations and memberships, we have in common the Chartered Banker Program and its derivatives. We share a commitment to raising professional standards across financial services and believe that ethical professionalism is the foundation of sustained success for our sector and for our economies more broadly. I know many of you, whether in Australia, Malaysia, or the UK, are busier than ever but it is also a time that might be worth considering investing in your own skills and knowledge through a suitable program. We face a very uncertain future. We know it will be very different to the past. I would say in absolute confidence, firstly, that the fundamentals of banking skills, knowledge, and experience remain vital, however digital our world becomes. With equal confidence for business executives' knowledge of the digital world, its opportunities and risks and operations is now core to your role as a banking or financial services leader. There will be an email sent out shortly on the recording for today. Once again, thank you everyone, to our speakers, to our partner institutes and all those online. Thank you for putting up with me, and stay safe and healthy. We hope to see you all at our next webinar. Take care.
Thanks very much. Thanks a lot, Prasad.
Cheers.
Thanks very much. Cheers.